Ladies and gentlemen, good day and welcome to Q2 FY23 earnings conference call of Glenmark Life Sciences. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Soumi Rao. Thank you, and over to you, ma'am.
Good evening, everyone. I welcome you all to the earnings call of Glenmark Life Sciences Limited for the quarter ended September 30th, 2022. From Glenmark Life Sciences, today we have with us Dr. Yasir Rawjee, our MD and CEO, and Mr. Tushar Mistry, our CFO. Our board has approved the results for the quarter ended September 30th, 2022, and we have released the same to the stock exchanges as well as updated it on our website. Please note that the recording and transcript of this call will be available on the website of the company. Now I'd like to draw your attention to the fact that some of the information shared as part of this call, especially information with respect to our plans and strategies, may contain certain forward-looking statements that involve risks and uncertainties. These statements are based on current expectations, forecasts, and assumptions that are subject to risks and uncertainties, which could cause actual outcomes and results to differ materially from these statements, depending upon the economic conditions, government policies, and other incidental factors. Such statements should not be regarded by recipients as a substitute of the exercise of their own judgment. The company undertakes no obligation to update or revise any forward-looking statement, whether as a result of new information, future events, or otherwise. Our actual results may differ materially from those expressed in or implied by these forward-looking statements. With that, I invite Dr. Yasir Rawjee to say a few words. Thank you, and over to you, Dr. Rawjee.
Shami, thank you. Good evening and welcome to everyone. I hope everyone's doing well. So before getting into the business performance, let's talk a little bit about the trends, the macroeconomic trends that are shaping our industry. So geopolitically, the uncertainties continue. Right? There's an energy crisis in Europe, there's inflation across the globe, and then there are some risks to global growth as well. Going forward, I'm sure you've seen all that. Now, with that as a backdrop, the geographies that where we are operating have done pretty well. So India, Japan, Latin continues to be on track compared to other markets. Europe is seeing a demand recovery, but at a slower pace. The good news is that the softness in demand has not impacted our business significantly because of the mid-volume and high-value products that we have to offer. Now, on the supply chain side, there have been disruptions, and that has impacted us some. But fortunately, we've built up inventory, so we should be okay going forward. There is talk of raw material prices, going up further, but so far things have been fairly stable. We've had increases, but very manageable. On the solvent side, the good news is that there's been softening across the spectrum except a few. So solvents have contributed very positively in this quarter compared to the last quarter. Overall, I would say that the raw material prices for Glenmark Life was under control. Primarily it's because of a better product mix, and our operating efficiencies have also kicked in very nicely in terms of solvent usage and process improvements in some of our processes. Now, as far as the performance in the quarter, what we need to highlight is that our external business has been doing exceedingly well. So on a sequential basis, we grew 16%, and on a year basis, we've grown about 13% in quarter two. So this growth in external business is, like I said, being driven by India, Latin, Japan, as well as there is an uptick in the CDMO business. Now, where we did have challenges was on the group business, with Glenmark Pharma slowing down quite significantly. So we are down 41% on Glenmark Pharma's business, YOY. And sequentially, we are also down 19%. Now, you recall that in Q2, we did have a COVID impact. So there is this 41% is not entirely on account of the COVID base effect. So even if you take that away, there is still a significant drop in the Glenmark Pharma business. So that coupled with our external business is giving us this, this sequential growth of 4%, and year on year, if we take away the COVID base, it's a negative 4%. So this is the how we deconstruct the degrowth in the overall business. But external business, again, I will reiterate, has been doing exceedingly well, driven across many geographies. Now, on the margin side, I would say it's all good news because the margins are very steady compared to the last year. Okay, so basically, again, it's a well spread out business across our non-commoditized portfolio, and we expect that the EBITDA margins will continue to hold, in spite of the decline in the GPL business. Now, on a segmental level, right, the generic business grew around 2%, okay, overall, right. Chronic business has grown 71%, led by our CVS and CNS portfolio. CDMO has jumped 27% compared to last quarter. Okay, so we are seeing a pretty good pickup on the CDMO business, which basically tells us that this inventory challenges that we had with our customers is going away, and there's also a uptick in the overall demand by our customers, within our customers' business. On the science side, we continue to chug along. We've filed 4 new DMFs and CEPs across major markets. So this is consistent with, our filing plan of around 8 to 10 DMFs this year. And the focus in the new product development is, we've got 26 APIs in the pipeline with a fair amount of focus on, differentiated APIs, more complex APIs. So this is good. 3 iron complexes are there, plus 7 oncology products and a few others as well, which are non-onco and fairly complex. On the capex side, again, I've got some very good news. So Dahej capacity expansion has just been handed over to us earlier in the month. So that 240 kiloliters has come online and will make a significant contribution in Q3. Along with that, our onco block has also come online, and we've already started validating our first API, and our second API is about to get validated. So there's 4 APIs here that will, be validated, one after another in the new onco facility. As far as the Ankleshwar expansion goes, that should come by the middle of Q4. There have been some delays because of materials and so on. But again, that will contribute very positively to our ability to service the business. So technology is, this is sort of a, largely a BI block, but it will also help us on the intermediate side. Now, finally, on the greenfield site in Sholapur, we've got permission already to build a 1,000 kiloliter plant, but we are going to go, in a measured way, just so that, we don't overbuild, and it will stay more or less hand in hand with how we see the business, coming on, the growth. So, our spend in capex in the first 6 months was approximately 100 crores, distributed between Dahej and Ankleshwar. Now, before I conclude, I'd like to re-emphasize that the business model is on a very firm footing with the broad portfolio spread across wide geographies. So, we are able to differentiate as a result of that in the market. And it also explains that our margins have been extremely steady on account of this, right? The only downside has been the GPL business, which I believe is temporary. And we expect that in the second half, it will bounce back. Not obviously, we'll have to discount the COVID element, but it will bounce back because, and that should put us in a pretty good, range with respect to, growth in the second half. Now, of course, the first half will weigh down on us, but overall, depending on how the GPL business shapes up, we should be on a reasonable footing with respect to growth as well. So with that, I'd like to thank you for joining the call, and I'll hand it over to Tushar Mistry, our Chief Financial Officer.
Thank you, Dr. Yasir. Hello and good evening, everyone. Welcome to our Q2 FY23 earnings call. I am happy to update you on the financial performance for the quarter. I would like to briefly touch upon the key financial highlights for the quarter ended 30th September 2022, and then we'll open the floor for questions and answers. We registered a revenue from operations of rupees 509 crores for Q2 FY23, registering a sequential growth of 4% and a degrowth of 9.3% on a corresponding quarter basis. Gross profit for the quarter was at rupees 269 crores, up 3.2% quarter on quarter and down 7.3% year on year. Gross margins for the quarter were at 52.9% with 120 basis points up compared to the same quarter last year. The gross margin expansion was mainly driven by a better product mix and incentives as well. Sequentially, the margins trended in the similar range. As mentioned over previous calls as well, the margins in the business have remained stable despite global uncertainties due to three factors. A, continuous efforts on cost improvement programs, thereby not only supporting our customers to be competitive in the market, but also maintaining our margins. B, timely passing of increased costs to customers where the headroom is low, and C, efficient supply chain management. EBITDA for the quarter was at rupees 154 crores, registering a degrowth of 9.3% year-on-year basis and 1.7% on a sequential basis. EBITDA margins are at 30.2%. EBITDA margins continue to be steady. However, higher utility costs impacted the margins by approximately 125 basis points compared to previous period. We continue to work on rationalizing some of these costs by moving to alternate sources. Profit after tax was at 107 crores in Q2 FY23, registering a degrowth of 7.2% year-on-year and 1.7% on a sequential basis. As Dr. Yasir mentioned, Glenmark Pharma business contributed about 26% during the quarter. R&D expenditure for the quarter was at 17 crores, 3.3% of sales. We believe R&D expenditure to stay around 2.5% to 3% range for FY23. Coming to working capital for the business, working capital days were at 173 days compared to 152 days as of March 22. As discussed in earlier calls, we have taken a strategic decision to secure excess raw material to ride out the various challenges created by geopolitical events while keeping costs under control. We expect the inventory levels to remain at this levels for a few quarters till the time we see some easing of global scenario. Debtor days are slightly higher, but that was due to some delayed collections in some geographies. However, the same is now normalized and we do not see any major concerns here. We continue to remain a net debt-free company with cash and cash equivalents of rupees 365 crores on the books as of 30th September 2022. Overall, a promising demand environment coupled with fresh capacities looks like a good recipe for strong growth in the coming quarters. With that, let us open the floor for Q&A. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Neha Manpuria from Bank of America. Please go ahead.
Yeah, thank you for taking my question. My first question is on the generic API business, sir. A couple of points here. You mentioned that the parent business that has seen a fair bit of decline should start improving from the next quarter. So, what would be a normalized level of supply in your view based on the order book that you have, for the Glenmark business? What gives us that visibility? That's number one. And number two, for the Dahej commissioning that is happening, should we see a more phased increase, from Dahej, or should the improvement in the API business be more material starting from the third quarter itself, in terms of the revenue trajectory?
Okay, so as far as the group business goes, right? One was in the first 2 quarters we had the COVID impact, right? And demand was lesser, right, than a typical demand. So you've seen like it's 26%, right, of our overall revenue. Typically, even after the COVID phase went away, we were seeing around 33-34% revenue contribution to the overall business, right? We expect that this will bounce back based on whatever visibility we have. So it should go back up to 32% levels, and at least in the short term. Longer term, I believe that it will decline, but this has been a bit of a blip here, right, in terms of the decline. So we have reasonable visibility that it should bounce back, right, at least in Q3, right? Q4 remains to be seen. As far as the Dahej increase, honestly, we've been waiting for this capacity to come online because it's been pretty tight at Dahej, right? So there'll be a pretty good, uptick in our ability to service business out of Dahej. And it will also help, getting our R&D validations planned faster. Because a smaller plant that was used both for commercial as well as R&D can now focus more on the R&D validations, because this plant that has been built at Dahej has got large capacity, and we can move a lot of the larger volume products into this capacity. So it would be phased, but it would be pretty quick in terms of the phase. I mean, I expect that in about a year's time, or by the end of this year, we should be utilizing that capacity at 50 to 60%.
Understood, sir. And sir, in terms of, Tushar, if you could just help me understand the cost implication from the commissioning of Dahej. Would we start seeing, the incremental cost from Dahej flowing through also from third quarter, or some of it is already factored into the margins that we are seeing now?
You're right, Neha. Some bit of expenses have already started building up in Dahej as we continued recruiting some people in Dahej. But on the other front, that is on the utilities and all, we will start building some costs from the Q3 onwards, which is all factored in our projections going forward.
Understood. And my second question is on the CDMO business. It's surprising how weak that business has been for us in the last 2 quarters with the inventory rationalization. You did mention in your opening comments that we are seeing some amount of normalcy with demand coming back. So should we see this going back to the run rate that we were doing in the previous quarter, of about 45 crores per quarter, or you think that the run rate now would probably be lower than that, given the inventory situation?
Neha, I think it will pick up, right? Certainly what we've seen in this quarter is a jump compared to Q1. So it's certainly picking up, right? And it may not jump to 40, 45 right away, but it will certainly improve, and maybe it will take a couple of quarters for us to bounce back to those levels.
Thank you. Neha, request you to join the queue for any follow-ups, as we have several participants waiting for their turn. Thank you. We have the next question from the line of Goldman Sachs. from Karan Vora from Goldman Sachs. Please go ahead.
Yeah, thank you for the opportunity. Am I audible?
Yes.
Yes, you are.
Yeah. So first of all, on the Glenmark business, so just wanted more clarity as in what is leading to get it that the demand environment was weak, but in the future or the visibility which you gave for Q3, we don't have right now. We don't have visibility beyond Q3. What's the reason for that? If you could elaborate more on that.
Okay, you have another question?
Yeah. Okay, I'll go ahead with the second one. So on depreciation front, so now that the plants will start coming online, how should we look at depreciation? And one more I had was on the generic API piece. So yeah, so on the generic API, this 450 crore run rate, which we are doing quarterly, like can we expect to grow from this base, or what is the broad base which we should look at for the generic API piece? Is it 450 crores or is it something else? So just needed more clarity on that. Thank you.
Okay. So as far as Glenmark Pharma goes, see, it's another company, and we don't have, I mean, just like our regular external customers, we don't get a very long-term visibility. We get a forecast, right? So the forecast, like I said earlier, right, is our Q3 forecast is pretty reasonable. We should get back into the 32-33% contribution to our revenue. Okay. We are hopeful that Q4 should also, their forecast for Q4 should also look similar, but it remains to be seen. The other element is that we should also be in a position to service both our external as well as group business. Okay. I'll let Tushar take the depreciation question, but I'll answer your third question, which is on our run rate on the generic API business. See, the generic API business is very strong. It's basically spread across geographies, and even if we do have a little bit of, muted growth in some geographies, many other geographies are contributing very significantly. So we'll comfortably maintain this run rate on the generic side. Just to sort of add and even to sort of answer Neha a little more, right, on her question on CDMO. See, our CDMO business is driven by 3 commercial projects. Okay, so here what happens is that variability in one of the 3 also makes brings in some variability. So, however, on the generic side, we are a very well distributed business, on the portfolio, on the customers, and across the geography. So, given that kind of spread, we'll comfortably do this run rate on the generic API. So, Tushar, if you give that.
So on the depreciation front, we are currently at a run rate of about 10 crores per quarter. I think it should add about another 2.5 to 3 crores per quarter going forward, with the Dahej facility coming in.
Okay, that clarifies. And just a follow-up on this. So on the generic API piece, is there any growth guidance which you are giving, or like a medium-term growth guidance, like low teens, mid-teens, any broad ballpark number?
External business will, like I said, comfortably grow 13 to 15%, including CDMO. So, right, generic plus CDMO should grow between 13 to 15%.
Thank you, Mr. Vora. Requested to join the queue for any follow-up. We have the next question from the line of Ashwini Agarwal from Demeter Advisors LLP. Please go ahead.
Hi. Thanks for all the answers till now, which has answered many of my questions. And congratulations on a pretty decent set of numbers in a very tough environment. One clarification on the working capital, Tushar, did you say that your days of working capital remain steady and the increase is purely due to price increases in raw materials and finished products and so on?
It is not because of price increases, it is because of the inventory that we have stocked up strategically for our requirement because of the global uncertainties. We have been building our inventories cautiously. So that will remain at this levels for some time till the time we see these global uncertainties easing off to some extent.
Okay. And the other thing I wanted to ask is, what are you seeing on shipping costs? I mean, we are seeing a lot of reports that ex-China to US shipping lanes are completely empty and shipping rates have crashed through the floor. What are you seeing in terms of shipping costs, and does that provide you any margin tailwind of some sort?
So Ashwini, basically our inward freight movement has largely been, we've switched to sea shipment. Okay. There was a time when a significant portion of our inward freight was also by air, but then post-COVID, or rather during COVID and post-COVID, we've switched and it's pretty good, right? But on the outward bound, right, because we are dealing with high value APIs, it doesn't make much sense to, go ahead.
I was saying it was high value, low volume.
Yeah. So it makes it, I mean, we continue to operate with air freight, right? And I mean, there is an increase, but manageable. I mean, it's not. It's definitely higher than what it was in pre-COVID days, but it's okay. I mean, I don't think it's significantly impacting. I don't know if Tushar wants to add what kind of. On the EBITDA, how much are we?
No, from a quarter-on-quarter basis, it is not, or from last year to current year, there is not significant change. But as you rightly mentioned, from pre-COVID days to this time, it is higher.
The new normal.
Yeah.
Okay, so all your outbound is air.
Most of it. We do have some high volume and relatively lesser value APIs that we do by sea. But it's probably around, on an overall bucket, it's about 15 to 20% at the most. Not even that.
Okay, I get that. So basically shipping costs or sea freight costs, which might be helping some other businesses, is not something that offers any upside in the current environment to you.
On inbound, it's helping, Ashwini, but not on outbound.
Not on outbound. Inbound is a bit of a help, not on outbound. And your sense is that second half working capital days, sorry, I had missed this slide and I see it in front of me now. The inventory days which have gone up from roughly 90 to 115, probably this is something that you will tackle in fiscal 24, assuming things are a little more normal. Otherwise, you're kind of going to run with higher rates. Both on inventories and potentially on receivables as well.
Inventory, yes. What you said was right. On receivables, as I mentioned in my opening comments, it's a blip that it has gone up temporarily, but it is normalized now, so it should rectify going forward.
Okay. Thanks, Tushar. Thanks for this clarification. All the best, guys.
Thank you. The next question is from the line of Sajal Kapoor as an independent investor. Please go ahead.
Yeah, hi. Thanks for the opportunity. have a more macro and more of an industry level question for Dr. Raoji. What kind of indications you are getting from European customers given the geopolitical situation there, seriously high inflation and energy crisis following what has been, a very difficult couple of years for the Eurozone. So now, even if EU can't manufacture these critical life-saving drugs locally, let's say in Germany or Italy, which is their traditional base for manufacturing drug substances, the patient pool is still there, the disease pool burden is still there, so drugs would have to be sourced from somewhere, right? So how do you assess the situation, or what kind of indications you are getting from your customers who are either based out of Eurozone or who either buy from yourself and then they distribute in the Eurozone? So I'm just trying to get a handle on, any opportunity in terms of Europe plus one coming our way.
Okay. I think you coined that term, You should. Yeah, I'm hearing it for the first time, Europe plus one. So, no, thank you for that. Basically, Mr. Kapoor, see, what happens here is that we've got a significant business out of Europe and demand has picked up. I would not get too excited about the pickup in demand compared to many of our other markets, but it has picked up. It remains because a lot of markets in Europe are tender driven. So Germany, UK, Netherlands, right? These markets are heavily tender driven. So the push from our customers is for, best cost API. And that's why, we've got to be a bit measured in terms of looking at this uptick in demand. While we'll get more top line, on the margin side, we'll continue to have pressure, right? Now, that's probably the game that the European companies will continue to play with us, simply because they're also facing huge inflationary pressure, right? And at the same time, they're probably not able to source locally. So this will happen, right? But let's see how it all plays out. But we are seeing a little bit, of enhancement in, from Europe on the demand side.
That's helpful, Dr. Raji. And secondly, quick question on our CDMO business. What is the revenue realization model, or in other words, how do we get paid by the customers for the development or the commercial service that we provide, as well as the drug substance that we deliver to these customers within our CDMO? So how do we realize the revenue? Is it included in our R&D expense, the kind of scientists that work for these customers, or what's the sort of revenue realization? That's the question, really.
Okay, so we don't have a model where we have an additional service cost. We continue to focus on at a product level, and all the customization that we do for the customer is done at our expense and built in, based on the commercial expectation on the business side. And that plays out better because over time that spreads out very well, and it hardly matters, right? So there's no point in burdening the customer upfront, especially because the business we are chasing, a lot of business that we are chasing are with smaller companies that don't have upfront budgets, to be able to spend that kind of money. So we'd rather, sort of put out a commercial price, and that's how we cost the whole thing. And in the whole scheme of things, adding, 5 or 6 CDMO projects at any given point, right, is not going to hurt our overall R&D expense. So that's the way we have built the model on the CDMO.
So basically realizing the economies of the scope from within the R&D setup that we already have, and leveraging the infrastructure to service the CDMO side as well, right?
That's correct.
That's helpful, Dr. Raoji, and wish you guys all the very best. Thank you.
Thank you.
Thank you. The next question is from the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. Yesterday on our CDMO business, these 3 contracts that are undergoing, what is the peak potential, assuming these contracts start delivering for these 3 businesses, for these contracts for the CDMO business?
Nitin, I'll have to request you to repeat your question here.
I'm saying these 3 contracts that we have for CDMO, what is the peak potential, revenue potential for this business as is, from the 3 existing contracts right now that we have?
Okay, let me tell you. So one contract has kind of reached a plateau, and there we haven't seen much variation in demand, even in the COVID period. So that has continued reasonably well. One has dropped quite significantly, went up significantly in the early COVID phase, but then that was clearly an inventory build-up on the part of the customer. And then, that has gone down significantly, which is now picking up, right? And a third one is operating, at 80 to 120% in terms of demand. So I would say 2 are reasonably stable, right? And one has sort of been like a yo-yo, right? So it's coming back, and I would say that, that should give us a reasonable, uptick in the overall CDMO business.
And beyond these 3 contracts, how any color on the kind of negotiations you've been having with customers? Have they been more promising than before? The scale and scope, has it changed, and at least in the conversation stage?
In the US currently, right, where our generic business is having some challenges, right, there is a huge interest on the CDMO side. Okay, and a very large percentage of our business discussions are with CDMO players. Okay, so we are seeing very good potential from the US on the CDMO business, right? And not only US, but even Japan, right? And the Japan discussions are more on the life cycle piece on our existing portfolio. So those again are likely to be pretty significant opportunities, right? So that's largely, some of the US discussions also will sort of, are with global companies, so it will also have an impact in other markets. So the CDMO, this business discussion has scaled up significantly because they do recognize that we are now an independent API company. Okay, being part of a large generic pharma, those doors were largely closed. But now those doors have opened up, and all said and done, Glenmark does have a lot of brand equity on the customer side. So, it's looking pretty good, I would say.
And if you would like to hazard a guess, by when do you see maybe the next set of big contract signings really happening there? Any broad time frame would you like to just hazard a guess on?
Yeah, so I won't hazard any guess, but typical gestation period once you do get selected is about a year to year and a half, because there are regulatory filings that essentially determine the timeline. So I would say based on discussions, it's certainly going to pick up, but whether it will start monetizing in FY24 remains to be seen. We do have a 4th project that should come, and it's a very significant opportunity, right? That's already in the works, right? We are in that gestation period in terms of us having developed the API, given it to the customer. They built their regulatory strategy, we supported it, but then there are delays from the regulatory side. So, that should come in FY24, and that would be very significant, right? Right. But these newer projects may not hit in FY24, but then I think in the following years, CDMO projects would be quite significant, right? Based on the number of discussions that we are having.
Okay, that's very positive. Thanks. And, from a capacity perspective, with whatever plans that we have, because the next sort of big capacity comes in only in 26. So with whatever visibility that you have on potential CDMO business, is the current capacity enough to take care of it?
So, Nitin, I'll go back to the gestation period, right? So the good part is that once we land the contract and sign the agreement to go ahead, right, then we do get that 1.5 year to build out capacity, right? In our 4th project, that's exactly what we did. Okay. So, initially there was talk of, working in about 30-35 markets, right? And then there was talk of, scaling it up to go to, around 57 markets. So, that itself gave us a view that we've got to build capacity. And so we even promised the customer, and we did it, that we build out capacity both in Ankleshwar and Dahej, because then it gives them a de-risking pathway in case, we run out of capacity in one of the facilities. So this kind of capacity build-up is relatively easy to approach in the CDMO space, because we do get that 1 to 1.5 year while, we are developing and the customer is engaging in filings.
Thank you, Mr. Agarwal. Request to join the queue for any follow-ups. We have the next question from the line of Anand Venugopal from BMSPL Capital.
Yeah, thanks for the opportunity. I had a question in regards to in Q1 FY23 Concall, you had guided for a 12% growth. on the top line. As of first half of FY23, it's like 9% down. Is there any reason for misguidance?
Yeah, so Anand, I explained that, our group business, which contributed, about 35-ish% even after COVID, right, has gone down significantly and in this quarter, and as a result, it has dragged down the overall number, okay, which is something that we didn't foresee coming, okay, and so, we guided to a higher number, but then, we still expect that H2, it should, bounce back some, and that should bring us to, mid-single digit kind of growth overall. But external business continues to do well, and, that should be the primary driver for our business.
That's all from my side.
Thank you. The next question is from the line of Saad Sheikh from BOB Caps. Please go ahead.
Yeah. Hi, sir. Could you just give capacity utilization for second quarter, given the decline in the significant business from the parent? And the second question would be, like you said, the 50 to 60% utilization of the new capacity you achieved by Q4, and given the formulation players struggling with price erosion and this new capacity addition, how do you achieve this utilization level?
You'll have to repeat if you don't mind. I mean, I wasn't able to catch. I mean, I understood it's on capacity utilization and on our new capacity. But did you ask about capacity utilization for the group business? I mean, was that the question?
No. The first question was current capacity utilization for Q2. And the second was, given the new 30% addition into the capacity and demand outlook not looking good from formulation player and the parent, how do you wish to achieve 50 to 60% utilization of additional capacity from the edge?
Okay. Yeah, thanks for that. So see, currently we are literally up to our neck. Okay, we are running at 95% capacity utilization before this Dahej has come in. Now, I'm confident on Dahej, and that's what I said. In about a year's time, we'll get to 50-60%, right, on utilization, because there's a large number of APIs that we filed out of Dahej that we know will become commercial within this 1 year. Okay, and that's why we are confident on that utilization. Now, with respect the sort of reduced, demand from group, that is not a phenomenon that's going to play out from now on, right? We believe that it will come back. There is another element that I want to put in here that you should look at. Overall, the growth is coming from a volume. Okay, not only group business, but even our external business is growing on the strength of higher volumes. Okay, so given the fact that there is erosion, and this is interesting, but it is price erosion without impacting margin, because we have introduced and will introduce a lot of second and third gen processes that will be lower cost, and a big part of that cost improvement will be passed on to the customer. Okay, so the volume, so the growth will be driven by volumes, and for that we would need capacity. And that's why we are confident that the new capacity will, will be sort of used at a level of 50 to 60%, in about a year's time.
Sorry, is the question answered?
Yeah, thanks.
Thank you. The next question is from the line of Vikas Sharda, from NT Asset Management. Please go ahead.
Yeah, hi, good evening.
A couple of questions. One is that I see the other operating income. So what does it consist of, and why has it bounced year on year almost more than double? And second question is on.
I'm sorry, it seems that we have lost the line for Vikas. We will move to our next question. That is from the line of Ranveer Singh from Edelweiss Wealth. Please go ahead. Ranveer Singh, your line is unmuted. Request you to please unmute your line and proceed.
Hello. Yeah. Thanks for taking my question. My question was related to the commentary. You mentioned that oncology, products are coming in now. So one API is validated, 3 probably more in pipeline. So wanted to understand the potential here, the revenue potential and timeline. And if you could just give a little, longer outlook for 2-3 years, what this project are going to contribute.
Okay. See, on the oncology, we've got 7 APIs currently in development. Okay, 4 of them, like we said, are ready to get into exhibit batch mode, and our customers are, ready to take the material and move on. As far as the longer-term outlook, the oncology portfolio is pretty rich overall in the small molecule space. So we will continue to populate our portfolio with new molecules, new oncology molecules. And we are pretty sure that this is going to be a good driver for the business overall.
Okay. So if you could just indicate the market size of products of 4 molecules which are under exhibit batches.
I think we said, right, that addressable market is what, 16 billion? Yeah, so the front-end addressable market for these 7 molecules is 16 billion. This is the front end, okay? I mean, this is not API, but then...
Yeah, understood.
Yeah, that's what.
Okay, thank you. That's it from my side.
Sure.
Thank you.
Vikas is back.
Yeah, we have Vikas on the line. Vikas Sharda, please proceed with the question.
Yeah, hi. So I was asking 2 questions. One is that this other operating income, what does it consist of, and why has it bounced so much YOY basis? And the second point was on Glenmark Pharma sales, that this decline, is it any product-specific decline or it's across the portfolio? And why did you not have this kind of visibility of a decline or a blip, say, by the end of the first quarter or in July when the conference call was there?
Yeah, you'll take it, the other income question. Take the other income.
So, because as I had mentioned in my opening comments, we have been accruing for the PLI income from first quarter itself. So that PLI income is a part of our Q1 and Q2 numbers, which was not there last year. That's why you see this bump in the other operating income part.
Okay.
Yeah. So to answer your question on the GPL sales, right? There has been, a reduction in demand even on the non-COVID side, right? And it's not product specific, right? So overall, there is a few products got moved around, and see, GPL has an option to buy from outside, okay? So it's not as if they would come to us always and buy from us. So that also could have some bearing on reduced numbers from our end. But I'd like to take you back to my earlier answer to Saad Sheikh on the volume driven growth. So interestingly, because we've introduced better cost processes, right? There has been, that improvement has passed on to many customers, including GPL, and as a result of which the volume drop may not have been as significant as the value drop. So to sort of address this visibility, see, a lot of this visibility is related to approvals. Okay. So certain approvals did come through, and then we had to switch to the lesser cost processes, the newer processes. And so we didn't have that visibility because we didn't really know how much, at what point in time that approval would come through. And this applies not only to GPL here, but it also applies to some of our external customers as well. So this element is also there that, you should sort of factor in.
Yeah, but this price correction or say switching to an external supplier would be a very product specific event, I would assume.
Yeah, see, we have had a pretty broad set of filings for our customers and their products with second, third generation processes, right? And we've had, we've had approvals coming in fairly consistently, right? Some high value APIs have got replaced with, better processes, and as a result, it has impacted. So, I mean, it's a mixed bag, Vikas. I wouldn't be able to pin it down to one molecule or even 2 or 3 molecules, right? Some of this has happened as a result of better processes. Some of this has happened as a result of lesser demand. And then, of course, there has been the COVID play as well, because nothing came on the COVID side.
Understood. Thank you.
Sure.
Thank you. The next question is from the line of Gujrot Ahluwalia as an industrial investor. Please go ahead.
Yeah, hi. Just have a couple of questions. First one on the capital allocation policy. So last year, I think when the company came out with the IPO, in the second quarter itself, company announced a healthy dividend, while the same has not happened this year. So we just want to understand, right, what is the capital allocation policy for the company? Yeah, Gujot. So you have seen that in last year, the dividend was almost 21 rupees to a share that was distributed. In totality, we distributed about 250 crores of dividend last year. Current year, as you see that there are capex programs which are going on. We have already given directions on what we are going to spend on capexes for the current year. Also, there is investment in the working capital, as you saw in the first half. So from that perspective, we are still positive that in second half we will be on track from a cash generation perspective, and we should continue to distribute dividends. May not be as healthy as what it was in the past, but definitely it will be healthier. So this is what is like confusing for an investor, right? Last year, the IPO, one of the purposes of the IPO itself was to raise cash for the capex, right? The company was embarking on a significant capex in Sholapur, brownfield capex in current sites, right? And still, company announced a dividend in just 3 months, like after the IPO. And now, after a year of accruals and probably performance is also absolutely fine. So, as an investor, you think, okay, the company's capital allocation is healthy and capital internal accrual is healthy, and they can continue to distribute capital to shareholders whilst also having enough for its expansion. So this is what is confusing, that last year itself everybody knew that there is a big capex, so investors are not expecting it, and now investors are expecting it, but it's not there. So this is what I'm saying, is there is a dichotomy here. So Gujot, significant part of the IPO proceeds was used in paying off the outstanding from the parent for the transfer of business to Glenmark Life Sciences, which was to the extent of 800 crores. 80% of the IPO proceeds went into that. On the other front, there were very clear areas identified for the IPO proceeds to be utilized. They have been used in the same manner. We still continue to have about 56 crores of funds from the IPO proceeds, which are being used for capex itself, right? And it was earmarked for certain projects, and it is being used out of that for those projects. The additional projects which are coming up were not a part of the IPO, which are getting spent from the operating cash, right? So that's how it is getting used.
So just to add to what Tushar said, we are not going to slow down anything on our capex spend simply because our visibility on the business is pretty solid. Okay, and it's just that the business does generate enough cash, right, to where, it makes a lot of sense to return part of it back to shareholders. So that's the plan, right? I mean, we would obviously, like Tushar said, right, take a measured approach, right, and, first look into the investment side, right, because that's driving the growth. I've been saying it that our growth is going to be driven by volumes, and that volume growth is visible to us. So that's the plan in terms of how we would deploy capital for investment.
Thank you. Next question is on the line of Jay Patel as an individual investor. Please go ahead.
Yes, sir. So my question was regarding what is our strategy as far as to reduce the parent contribution, because as you will be knowing, sir, the pharma business, our parent has already received some Form 483 at one of the units, and so that's all what I wanted to know, that our strategy as far as product selection is concerned, so that our products grow in such a way that the external business grows, it lifts the top line as well as reduces the client concentration risk.
Okay. So see, as far as the portfolio buildup is concerned, our entire approach to our portfolio buildup is for driving our business. Now, no doubt, the group contribution or the group feedback on certain products, just like our other external customers give us feedback on products, is pretty similar, right? So even if we were to invest in R&D in APIs, that the group company wanted, we would still have other customers, right? So it's not going to change because our focus is completely driven by the value that particular API will give us going forward. It's not driven at all. I mean, there's not a single decision in our portfolio that is driven by Glenmark Pharma. It's an overall evaluation that we make on our portfolio. So to that extent, I don't think, this is, what happens at Glenmark Pharma is going to sort of determine our fate in terms of our portfolio going forward.
Okay, right, sir. So as far as our future product selection is concerned, would it be safe to assume that future product selection would depend on external demand, and our target at the end would be to increase the external customer contribution? Would that be fine to assume?
Yeah, simply because Glenmark Pharma is one customer out of, even if I looked in the top 20 customers, right, generic players, we are working with most of them. So then in that case, right, our portfolio decisions are driven by all of them and their interest, in our portfolio.
Okay, right. And so last question would be, would it be right to consider that our CDMO business, as we are dealing in end of life cycle management, so our CDMO business is actually a contract manufacturing business, whereas the innovator does sort of technology transfer to us, and we are not involved in development part of the molecule, but we are involved in manufacturing part of it. Would it be right to assume this way?
Okay, it's a very good question. Okay, basically, the business that eventually will be generated would be with contract manufacturing, right? But because there is a fair amount of customization on both the life cycle work as well as the 505(b)(2) work, there is an element of development as well upfront. And I think I answered Mr. Kapoor saying that we do invest in R&D, right, in the CDMO projects with that objective of either, tailoring the process to the customer's regulatory filing, earlier regulatory filing, right? So that has to be done in order to make that pathway smooth for regulatory filings. Okay. So that element of customization comes in the lifecycle management projects, but on the 505(b)(2) it's even more, because we basically may end up doing another salt or another polymorph or some variation of the molecule, right? So there is that element of development, but it's largely limited to process development, polymorphic, changes, or salt changes. So I mean, it's a mixed bag, but there is a development element as well.
Thank you. We take our last question from the line of Janesh Shah as an individual investor. Please go ahead.
Yeah, good evening, sir. Just 3 questions I have. One is, can you just reiterate how, given that now Sholapur is going to be a little bit in a calibrated manner, so how would the capex intensity would look like for next 2 years, including the current year, maybe for next 3 years, I would say. And second question with regard to the margin trajectory. I mean, we have been bringing in more complex products in our portfolio, and we are also having the processes improvement, which is also likely to give you a little bit of a better cost structures. And so in the CDMO, where probably a 4th product or project is going to start, how do we look at the margin trajectory for next couple of years? And of course, I think there are also backward integration projects which are also being involved into it. So all these put together, how do we see the margin trajectory going ahead? And the third question is on the US FDA inspection. How is it being stacked up for the projects? I mean, given that a lot of last time you had said that it's been 3 years and it's been due. Thank you.
Yeah, thanks, Janesh. So, look, as far as capex goes, right? I mean, we have 3 plants. So we've got we've got the Dahej, we've got Ankleshwar, we've got 4 plants, but we are not making investments in 2 of the smaller plants. Okay, so Dahej, Ankleshwar has got room to expand even today, and Sholapur is a greenfield site. Now, considering that 75% of our business is a regulated market business, we've got to be clear that depending on how the volume growth is shaping up in the regulated markets, we may need to do a little more in the plants that have already been inspected. Okay, because then there is no lag time between our taking in the products in these plants and then supplying it to the market, right? So that's clear. Sholapur will drive initially the ROW markets as well as the backward integration play. So that we are also clear on that, and I've mentioned that in the past that look, we would have that ability to decide in a relatively short time what we do, right? So you're right that we would decide how this would go, but largely speaking, our capex spend would continue at a pretty similar rate, depending on how the market demand is shaping up and how our new launches and so on are coming in. Okay, coming to your margin improvement question, certainly if the world was the same, and let's say we dialed back to 2018 and 2019, then I would say that all the the new CDMO, the CIP, and the BI would all contribute to improving the margin. But the world we live in today, right, has got enough headwinds for us to say that all this is going to help us to keep our margins going at the 30-31% level. I don't want to stick out my neck right now and say, I'll have 2 or 3% margin expansion when I know that there's all kinds of trouble on the horizon, right? And we have to manage that trouble, right? So you're right, your analysis is good, but Janesh, I would be I would be a little careful. I'd only be too happy to, do better margins, and I think if things were to improve, right, in the world, we probably, right, give you that extra, 1 to 2% jump on the margin. But right now, I don't want to guide to that. Okay, I mean that's not going to happen. As far as your US FDA inspection question goes, yes, we've crossed the 3-year mark for Dahej. In fact, we are at 4 years now, right? And for Dahej and Ankleshwar is at about 3.5 years. So we are expecting an inspection anytime, and we are also geared up for it.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for the closing comments. Thank you, and over to you.
So thanks everyone for joining. I think
thank you very much.
Thanks for joining, and wish all of you a very, very happy Diwali. Right. So thanks again.
Thank you very much. Ladies and gentlemen, on behalf of Glenmark Life Sciences Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect.